welcome to the FF News Virtual Arena. On today's episode, we're going to be looking at the digitisation of trade and working capital. And joining me, I have two gents right at the heart of that topic. First up, we have Martin Mccann from Trade Ledger. Martin, how are you doing here today?
Good morning, Doug. I'm doing very well, thank you. Nice to be here.
It's lovely to have you on. And Martin, for our audience who might not be aware, could you talk us a bit through Trade Ledger and your role there, please?
Yep, certainly. So I'm the CEO and founder of Trade Ledger. It's a business I started in 2016. And what we do is provide lend tech, which is considered a subcategory of fintech. Essentially, what we have created is a modern sort of platform of technology and data services that help large banks to modernize, digitize, and improve the lending and credit services that they provide to businesses of all types globally.
Absolutely incredible. Well, I think it's going to be so important, that whole discussion we're going to have where we look at organizations of all sizes. And speaking of, we've also got James Binns here from Barclays. James, how are you doing here today?
I'm great, thank you very much. It's great to be here, Doug, with you and Martin. So thanks for the invite.
Our pleasure again. And so James, could you talk our audience through your role at Barclays, please?
Sure. Well, I am the Global Head of Trade and Working Capital at Barclays. So I run the trade and working capital business globally. I've been doing that for the last 3 years. And obviously, it's a really exciting topic at the moment with everything that's happening in the trade finance sector.
Yeah, it is one part of finance that really seems to be moving at a severe pace. So with that in mind, I think to kind of set the scene, James, if I could stick with you first then, what was in your idea, the state of the digital processes in trade finance pre-COVID-19? Was it almost fair to say that it was almost laggard compared to other parts and other verticals within finance?
Well, I think there was a lot of noise and excitement, a lot of emerging solutions, particularly around blockchain. So single transactions were making big headlines. And on the surface, I think it appeared that the trade finance sector was making a lot of progress. But I think COVID was a real wake-up call because COVID revealed the moment everyone went into isolation and working from home and so on, just how we needed still to fix some of the basics. So, for example, requirements for wet signatures were still widespread across our sector. So simple things like using DocuSign and implementing DocuSign created huge efficiencies and improvements to customer experience and so on. So I think what COVID really taught a lot of us was that we've got to fix the basics. And certainly for me, what that means is fixing core connectivity, core systems, so that you're then able to connect in a more agile and flexible way to the outside world to start to realize some of the very excellent and interesting and exciting solutions which are starting to emerge across the trade and working capital sector.
That's absolutely incredible. And it's such an exciting time to be part of that industry. And I'm really interested, Martin, if you have any follow-up on that kind of, seeing that technological journey, that digital journey that James was mentioning and your ideas on that too.
Yeah, we're seeing the same thing as James. You can kind of look at, obviously we're looking at it more from a systems technology and data perspective, as I'm not a banker, but you can kind of look at the market as sort of pre-COVID and blockchain hype, which was happening at that point in time, and sort of post-COVID. And I'd say in the sort of 10 years before COVID, the actual amount of investment on, I guess, product innovation in a digital environment was probably lower than retail banking by quite a way, but accelerating.
Yeah.
And like James said, the COVID crisis with offices closing particularly showed up some of the aged infrastructure and the manual nature of a lot of the processes in a lot of areas of the products. Mm. So there was an urgent need to implement changes quickly. So we've seen in our business, huge increase in demand for sort of the modern sort of technology type solutions that we provide across the board. And I guess an increase in expectations in terms of the speed and scale at which it can be delivered. So pre-COVID, banks were more thinking about, well, let's experiment with this type of new generation enterprise technology and make a decision about rollout, in the next year or so. So the whole process will be 3+ years. We've got customers who've come to us post-COVID and said, we need to modernize in 18 months, which we're like, wow, that's welcome news. It's a bit of a challenge, but let's have a conversation and see what's possible. But we're seeing that the expectation of what needs to be done it's sort of gone down from sort of 5 years to 3 years, and some people are even thinking 18 months is the timeline we should be looking at. And there's no barriers or concerns about modernizing all of the core systems, the data types, and all of the ancillary capabilities required to provide much more frictionless and better user experiences around all aspects of trade and sort of cash management products.
Really kind of interesting, James, seeing how it's been technological, but also a cultural change, or cultural transformation really within organizations and institutions. So with that in mind then, James, what do you think that cultural and tech transformation will mean to help working capital be freed up for both suppliers and buyers across the globe?
I think what it means is we'll end up with a far more open technology setup, which is far more connectable and far more driven by host-to-host connectivity. And I think as a result of that, we'll be able to offer a more simplified, more focused solution set and processes, which will enable a much faster decision-making environment. And I think that faster decision-making environment is not just about the banks, it's also about clients, it's about or businesses. It's about how quickly businesses can approve invoices, for example, and make payment decisions. So it's across the spectrum. But that faster decision-making will drive quicker time to money, which will drive down the cost of funding in supply chains, and will also drive down the financing gaps in supply chains as well. So for me, that's where I see all of this going, is a far more efficient, consistent, predictable source of funding across supply chains.
Yeah, and I think that's going to really change every aspect going forward. It's going to be quite exciting to see how this is going to be an impetus for so much transformation and change around the globe. And James, Martin, I also want to come to you as well. I know Trade Ledger, your speciality is with a certain type of organisation, but do you also have any perspective for what this means for instance, as we were talking with James there, the buyers and suppliers of the world?
Yeah, so I agree with everything that James said. I would sort of use the term, we're moving to data-driven lending, which takes a lot of the friction out of the process and creates a lot more automation. So what James called sort of host to host, I think he meant the same thing. What we're seeing is, the proliferation of APIs on both business and enterprise systems and on bank systems means that the end customers can simply connect up the system data and have a much more consumer-like experience, much like what's been happening in retail banking now for the last 10 years. So it's getting really, really interesting, because you don't need to be an expert in the lending products in order to get access to the lending products in this sort of new sort of paradigm of data-driven lending. Whereas beforehand, there was a lot of research to be done. You need to engage with specialists in the bank to walk through the process. We're seeing that more and more parts of the process are no longer manual, don't require any sort of documentation to be created and passed between the bank and the customer. There's a lot of time saving in the operations by the bank, and a much better experience, which is more focused around exactly the questions that the customer wants focused when it comes to finance and working capital. So it's extremely exciting. I would sort of summarize that data-driven lending is essentially providing the sort of consumerization of trade and working capital management, and giving the customer experiences in sort of business banking that consumers have been getting used to and enjoying in other parts of their personal life now for about a decade.
Now, Martin, I've got to stick with you as well, because it's brilliant to hear how these customer demands are changing and how the internal structures of large-scale organizations are also changing to meet those demands. But let's get to kind of brass tacks on this. It's very much a tech transformation. So I'm really interested to see, Martin, your perspective on what technologies are playing the major part in this almost revolution within trade finance.
Yeah, I think it's a revolution within banking. It's just trade and working capital's turn. So it's moving at different paces in different parts of banking. Quite interestingly, if you look at, I guess, the types of technologies, it's very linked to the type of change that needs to happen within the banks. So this is discontinuous change, non-linear change, which is the most difficult change for a bank to manage. And it's been, I guess, the one that the banking sector has at least had to deal with. And by that, I mean that within a period of 3, or certainly by 5 years' time, the types of products and the basis on which banks compete within sort of trade financing and working capital credit products generally will be very, very different than it is today. That's how fast it's going to happen. Having gone through a decade where things have moved very slowly in terms of change, because of regulatory pressures, different types of competition coming into the sector, and the availability of technology, we're going to see that accelerate. In terms of the technology, though, it's probably not as bleeding edge as most people think. So the hype cycle around blockchain and DLT and to a lesser degree crypto is sort of dying away, and there hasn't been a lot of blockchain and DLT use cases, particularly, which have been adopted at what I'd call sort of bank scale. So the bank that James worked for is the kind of scale that I'm talking about. What we are seeing is the adoption of best practice technologies, patterns, architectures, use of digital data sources. We've seen those developed in other industries. So I'd call it sort of best in class enterprise technology. It's all around moving workloads to the cloud, making the whole core systems more modular, recomposable to meet new use cases. And fundamentally, what's driving the change in the propositions and the customer experience is the pervasiveness of APIs throughout banking, which also interestingly, probably for the first time ever when you're talking about technology, at least in living memory, is being driven by significant changes in regulation to increase competition. But pretty much every banker in the world now knows about APIs and expects any solution or change that they're driving to be based around the availability or the development of some type of API, and backing onto that a very modern sort of cloud-based architecture.
I think that is going to be so critical, but I do love that notion that now you can't get away from having an API based infrastructure and being able to plug in and play like that. And James, I wanted to hear your perspective maybe from Barclays as well. How critical having that open application interface has been for really enabling innovation on your side too.
Oh, I think it's absolutely critical, 100%. And I also agree on Martin's point on moving to cloud-based architectures as well. Or technologies, and you're starting to see that move now across the big banks in terms of a willingness to start putting their transaction engines or their platforms onto externally hosted cloud-based platforms with API gateways off the backs of them. And I just think that's absolutely critical to what I was saying earlier on, which is, and I think Martin's saying exactly the same thing, it's about connectivity and ease of connectivity. And once you've got the connectivity, then you can start adding the different data feeds over a period of time, if necessary, to start layering on the data you need to make more and more decisions. And I suppose the irony here is the complexity is around adding more and more different data sources. So, for example, in a trade and working capital environment, not just invoice and payment data, but also all the logistics data, the shipping data, and so on associated with the movement of goods and services. And all that complexity around that then ultimately simplifies everything that we do and how we provide funding to the working capital cycles of supply chains.
I think we're seeing that in, for instance, payments as well. We're seeing how data is becoming almost the new oil, and with standards like ISO 20022, we're seeing the embedded of data to just provide customers, merchants, and also the institutions such a wealth of information. It's absolutely incredible to see everything moving in tandem in this way. Now, we've very much focused on how this connectivity can enable these organizations to trade more efficiently and actually kind of look at how they can receive funds more efficiently. But Mccann, I'm also really interested in how digitizing can help organizations actually just free up working capital quicker and more efficiently.
Good question, Doug. I guess the key thing here is when you look at organizations, the smaller the organization, the less, financial maturity that they have. So the problem that the businesses have is trying to identify the opportunities for better managing working capital, and understanding how they match those opportunities or problems when it comes to cash flow management with services that their bankers provide. It's a pretty involved area. I know James for a number of years now, and I'd consider him one of the world's experts on trade capital. And when we have conversations about some of the products, there's a point in time where I lose track of what he's talking about. Unfortunately, the business owners don't have that level of understanding. So really what the technology enables us to do is utilize the digital data of the business to avoid the need for business owners to get up that sort of financial maturity curve. And it enables them an easier on-ramp to talk to the bankers to match their needs and the opportunities for cash flow improvement with the solutions and products that their banker can provide. So what essentially is the key concept we're seeing here is a move away from, I guess, what's typically called the vertically constructed manufacture, distribute and service product concept that's dominated the banking scene for probably 3 decades, to a customer-centric, needs-based analysis approach, where the customer might not even know the definition of the products. So, for example, most people listening to the call probably don't know what a forfeiting product is, and probably don't have a desire to know what it is. And if they need it, they don't necessarily need to know what the product works, how it works, the ins and outs of it. They just know the outcome that they need, which is they need, better cash flow management. They need to bridge a gap in cash flow, or some changing dynamics in the way that their business operates, which impact cash flow. And when you connect up the data of the business with the expertise of the bank and the systems of the bank, that's what you get, is the ability to actually move to needs-based analysis and the ability for more frictionless consumption of the lending products that the bank can actually offer to help those customers.
I think that's really, really quite an interesting paradigm, because it's very, as you mentioned, it's become very customer demand driven as an industry. But so, James, I've then got to kind of hear your perspective as well from an institution, and see where you think the digitization journey is going to end up in the next 5 years, when, as Martin's saying, it's very customer demand driven, but at the same time, the customer doesn't really want to know sometimes what the product might be. They just want to get the service at the end of it.
Well, first of all, I just want to say thanks to Martin for what he said about me earlier on. The feeling is definitely mutual from a technology standpoint. As you probably revealed earlier on when you corrected me on the old-fashioned host-to-host terminology. But just to go back to your question, Doug, I think what it means to clients ultimately is the impact it has on them, the value that we can deliver to clients. So, for example, just to go back to the question you asked, Martin, about how clients will improve their working capital cycles. Well, greater data, greater technology means that when clients get paid by their buyers, or businesses get paid by their buyers, they should be able to reconcile those payments more quickly, and in doing so, reduce the days sales outstanding. If you reduce your average days sales outstanding, you increase your cash flows, you reduce your working capital requirements. Equally, if you look at the payment side of a client's balance sheet, then instant payments enable businesses to pay on due date rather than the day before due date. So automatically they gain an extra day on their days payable outstandings. And of course, that again is working capital positive. It generates cash and reduces the financing requirements in a working capital cycle. And I think the really exciting thing here is that with the type of technologies that we're starting to think about now and implement now, and everything we're discussing today, it means you can start to look at that value set or that paradigm, not just at an individual business level, but across entire supply chains. And when you can start to optimize the working capital cycle at a supply chain level, that's where you can really drive, I think, significant benefits in terms of ultimately the cost of delivering product to end users, because every product, from start to finish requires funding and financing, which is part of the cost of producing that product. And ultimately, I think the way this is going to go is supply chains will start to compete against each other on the basis of how efficient their funding is from end to end, because that will become a substantial cost driver of that funding, particularly as if and when we move back into a higher interest rate environment.
Yeah, now that is absolutely fascinating, kind of seeing how that might change the industry. Well, I hate to use the word, but holistically, just really everything from a top-down notion is just being revolutionized. Now, Martin, as I kind of alluded to earlier on in our conversation, I know Trade Ledger has a very particular suite of businesses that you help and look after, but I'm really interested to kind of go back to that and look at how small, medium enterprises have taken to these new technologies that we've been talking about, and how maybe fintechs or financial institutions can help these organizations actually get access to these innovations when it comes to their working capital.
Yeah, the small business sector is really, really interesting. It's very, very different from sort of larger corporations. So for example, small businesses have much more digital data than larger corporations. All of their accounting systems, all of their operating systems are cloud-based modern systems which are API capable, and the data structures and the richness of the data that they have is generally better than larger organizations with systems which are typically 15 plus years old. In terms of the change that's happening with digitization, that's going to significantly help the smaller businesses who've very much been struggling to get access to the same types of services as larger corporations, because it was difficult for banks to understand how to evaluate consistently the situation with those businesses. To a larger business, there's a higher degree of consistency. But now with better digital data, even though it's different, what you can do is actually have much more customized propositions and even new products designed specifically for SMEs by the bank. And these products can be much more flexible than products previously. So really what we have is a new sort of digital data foundation, which enables some of the benefits we talked about. But ultimately where it's going to is the creation of an ecosystem of SME sort of financial services providers. And what we're starting to see already is an appetite by banks to say, here's the segments that we can service. Here's the things that we would love to be able to service, but for various reasons we can't. It could be cost to serve, it could be regulatory, it could be risk appetite. There's a whole multitude of reasons why. But they will be able to help the SME still connect up to those services from other people, or they may be able to form a value chain where they only provide part of the solution. It could be, for example, banks are very, very good at regulatory compliance, so things like know your customer, anti-money laundering, etc. So they might provide that as a service to a non-bank provider to provide a cash management or a credit service, which they're unable to provide to that sector, for example. Maybe it's the wrong industry, the wrong country, or whatever. That kind of ecosystem collaboration, in my view, is the only way we're going to solve the significant supply and demand gap at the smaller end of the market. Depending which research you read, that gap is as big as sort of 30% of the actual total market. The supply and demand gap for small companies, the S and SME. It's not as big as the companies get bigger. But ultimately, I think we'd end up with an ecosystem of different types of solutions, which are not all coming from the same bank or the same alternative to the bank, but it's actually a collaboration to create a new type of proposition where components of that value chain are actually contributed by the participant in the ecosystem who can best provide that at the lowest cost consistently.
I find this changing ecosystem to be absolutely incredible, and I think it's going to change the way we really view finance going forward. Martin, with that in mind, it's kind of touching on open finance to me, having this new ecosystem of new financial service players that aren't typically financial institutions. So, Martin, in your idea, how important will open finance be when it comes to connecting all of the above, all of those new financial players in this ecosystem who traditionally weren't within finance?
So it's pretty critical. There's some terms which are sort of not well defined. So a lot of people would describe what I just talked about as embedded finance. But open finance would be considered, if you like, the foundational platform which enables the embedding of those components and the creation of that ecosystem. So open finance is kind of an extension of open banking. So open banking was a specific UK regulation, which there was also an equivalent which started first in Europe called PSD2, Payment Services Directive 2. And really what they're about is trying to create a stronger sense of competition and a better level of service and innovation in banking services for businesses and consumers. So that comes back to the concept I talked about earlier around APIs. So open finance is really about moving away from the idea of just being able to provision APIs to be able to just provide data that the bank has. It could be transaction data, it could be other data, to a third party in a consented journey, it's called, in a secure manner, to actually being able to provide a component of a service or a whole service in that embedded fashion. That's the switch that we're starting to see today. We've been through the ABCs of using APIs, that was open banking, just to shift data around in a much more efficient way. And now we're building complete new solutions or components of solutions, which can be assembled in lots of different ways to come up with better versions of existing products for cash flow management, as an example, or to create brand new products. And that's really what's different about this phase of change in banking versus other ones. It's not predictable. All we can say at this time is it's probably going to change very significantly in a 3 to 5 year time period. But we don't really know what that next horizon of products and services will look like totally. In this environment in other industries, we've seen the law of unintended consequences. By creating that level of capability and competition, something that nobody expects happens, which changes the direction of the market. And it's entirely possible that'll happen in sort of trade finance and cash management services in the next 5 years.
It's going to be, I know I've used the phrase often throughout this whole conversation, really revolutionary and just a complete change. But Martin, that future sounds so exciting. But James, I've also got to get your opinion on it because you're embedded right at the heart of one of the largest financial institutions. And I'm really excited to hear your perspective on the changing role of financial service players going forward in this new ecosystem.
I'm hugely excited by the move to more open banking, open architectures, call it what you want, API connectivity, and everything that Martin says, I agree with. And the thing that excites me is you only need to look at the financing gap worldwide. It's trillions. there's plenty of room for new entrants into the market. This is not a threat to banks. I see it as an opportunity. As I was alluding to earlier on, you look at supply chains at a holistic level, they are hugely complex, multi-layered chains. And with so much complexity across borders, across different regulatory environments, and so on. And I think with the connectivity that we're talking about, there's the ability for new players to come into those supply chains to start enabling some of the funding that we're talking about here to reach parts of the supply chain we just can't reach at the moment. And I find that hugely exciting. You talk to a large buyer about supply chain finance. That large buyer may have 5,000 or 6,000 different suppliers. There's absolutely no way that one solution fits all of those 5,000 or 6,000 suppliers. It's probably going to be 6 or 7 different solutions. But what we're talking about in the future is those 6 or 7 different solutions in the future could be potentially delivered through a single platform by multiple providers, which when you think about the access that gives to those 5,000 or 6,000 suppliers in terms of more efficient, more consistent, quicker funding, I think it becomes really powerful. So I see this as a huge opportunity. I'm really excited by it, frankly.
Well, I'm a big fan of actually. We've talked big throughout this whole conversation. We've talked about these grandiose changes within the trade finance industry. But to kind of wrap up, Martin, I'm going to end with you and ask, how can we enable that ecosystem? We've often talked in 5-year tranches. I want to see, from your perspective on the tech side, how can we get from, as you said, the ABCs of the open of APIs to this brand new ecosystem where supply chains can really give access to everyone within that chain?
Well, I would say that it's at this point it's inevitable. The change is happening. It started. It's not quite a juggernaut yet, but it's gathering momentum, and we can see the blockers being cleared out of the way. As I say, I don't believe, certainly in my lifetime, there's been this type or this level of change that's ever happened in the banking industry, and it's coming from multiple fronts. So I would say the correct statement is, you need to get out of the way of the juggernaut, or you're going to get flattened by it. It's starting to come together and pick up speed. So the concept that I've started to talk to the banks that we deal with as customers is the idea of nonlinear change and nonlinear banking models, and really what banks need to start thinking is how do you bring imagination into thinking about what 3 years could look like. So start from the destination and work backwards, and just realize that a lot of the blockers that have been there in the last 3 years are either already gone or they will be gone within 3 years. So for me, I get very excited about thinking about the concept of, I've got a concept in mind, as a pet project of mine called sort of digital CFO, where as a business owner, I can just go and run my business, and I can get access to the capital that I want just by letting the ecosystem of partners that I trust and I have consented to use my data for a specific purpose to actually recommend how my business can be optimized, and to give me access to the capital that I need to make an impact in the world. Because I think there's too many people in the world who've got passion for things that they want to do, but because they're in creative industries, or they're from backgrounds where they haven't had access to sort of financial education or capital, they just don't have the opportunity for that on-ramp. And I think what we're doing is starting to realize the potential of business and banking to have a real sort of positive impact on humanity and communities. And I can see banks and financial services playing a more central part of that within sort of 3 to 5 years. Picking up on what James said about the excitement about being able to reach parts of the supply chain we never could. We can also look at different purposes and different types of services we could never imagine 3 years ago. So for me, it's inevitable. You've only got two choices at this point in time: disrupt or be disrupted. And we're already seeing banks who are making brave choices ahead of the tsunami that's coming at us in terms of this change. And they're disrupting themselves. They're changing everything about their business to get ready for the adoption of this open finance layer, which is going to create this ecosystem which is vastly different within a very short period of time in terms of how banks are considered and interact with the communities they operate in.
Now, I think that is, again, I'm going to use the phrase again, it's such an exciting future because it's a part of finance that really does impact every vertical, every facet of human life. And I know that is a big statement, but it is very exciting to hear some of these changes. And it can't come at a better time after, effectively 2 years of lockdown, and a lot of businesses, small all the way to large, have been affected, and seeing how we're going to democratize that ability to gain access to working capital through technology, to me, it's just absolutely fascinating. But guys, we've come to time. I've just got to say a massive thank you to you to hear your insights to experts. I've learned so much, so thank you so much. And I've also got to say a massive thank you to our audience as well. You can, of course, catch the rest of the series and much more over at ffnews.com, and of course YouTube, especially LinkedIn, where you'll see me in the comments. So I've got to say, Martin, James, I hope you've enjoyed yourselves. Thank you so much for being on the show here today, and I hope you have a lovely rest of your week. Goodbye.
Thank you.
Thank you, Doug.
Thank you.